cover different ways for a firm to raise capital and the general cycle that a small business will go through in order to evolve into a much larger firm. Let's get after it. First off, it is important to point out the two main methods of raising capital. Number 1, rewards-based crowdfunding, and number 2, equity-based crowdfunding. Rewards-based crowdfunding refers to an investor giving money for some sort of amenity/reward. Some examples of websites that facilitate this form of crowdfunding are Kickstarter and RocketHub. This method, as determined by the name, aims to raise smaller funds from more investors. The second listed form of raising capital, equity-based crowdfunding, refers to an investor giving cash for an exchange of equity. Usually, this form of investing will come from an individual with a higher risk tolerance than the average investor, because if the business goes south, they must be prepared to lose all of their equity. Even though that both of these methods are inherently different, they both carry the important requirement that you must follow up and prove yourself. One very common form of equity-based crowdfunding that we are all familiar with are the many exchanges of the global stock market, which gives everyone access to invest in a company and hold equity in the form of shares. Though this equity per share is extremely small and you may not have a real influence in the company's decision-making, you are given the freedom to choose from any company. Thanks to the Securities and Exchange Act of 1933, it is now a federal requirement for a publicly traded company to disclose financial statements to the public, as well as any other information that will affect investors' perception of the company, such as executive compensation. This same Act of 1933 also made it illegal to use fraudulent and deceitful techniques involving the sale of securities. Moving away from the stock market, when someone buys a larger portion of equity of a startup, they immediately enter the valley of death. There, the net present value of the investment is negative and it is the entrepreneur's job to return the investor his initial equity amount, as well as additional gains or profits. Once the NPV reaches zero and continues to climb, the valley of death is exited and the investment is in the money. Based on this information, it is extremely important for an early investor, as well as a venture capitalist, to realize that they are really investing in the person or people running the company. Speaking of venture capital, this stage comes along once the company has already proven that there is a real demand for its products or services. Venture capitalists are high net worth individuals looking to scale a great idea into an 8 or 9-figure business. A great source for experiencing venture capital negotiations is the show Shark Tank, where extremely successful and high net worth individuals have opportunities to invest in many companies. All of these investors demonstrate their attention to the person running the business, as well as the past success or cash flows of the business. If the investment proves to be extremely successful for the venture capitalists, the company may be on the stage to be bought out by a private equity firm. This is a common way for venture capitalists to cash out on an investment that has already exhibited massive growth. Sure, this may not be the case for every startup, but it is a typical outline of the business cycle, revealing who hops aboard the firm and when they come into play. I hope this was able to clear things up. Thank you for watching. See you next week.